Hello, welcome to Accounting Hub. I'm Professor George Carpin, PhD in accounting, and our topic today is defined benefit pension plan assets. This is a video of a series of videos about defined benefit pension plans. All of the other videos, they are in our video description, as well as in our playlist. And guys, subscribe our channel. You will be the first one to know when a new video arrives. And like our Facebook page, Accounting Hub by Dr. Scarpin. So what is defined benefit pension plans? Promise fixed retirement benefits defined by a pension formula. We have a lot of uncertainties on this kind of plans. Rate of return on plan assets, what we will be talking today, number of employees, age at which employee will choose to retire, life expectancies, inflation, and so on. And here we work with an actuary that is a professional trained in a particular branch of statistics and math, hired by the firm to assess the various uncertainties and to estimate the company obligation. For instance, rate of return, age, life expectancies, and so on. Okay? So what do we have here on pension expense? Why are we talking about pension expense if we are talking about plan assets? Because the return on the plan asset is a contra account of our pension expense. It reduces our pension expense. So it is not a revenue. Here it is an a contra account of expense. We are reducing our expense. However, here we have some topic here. The actual return is adjusted for any difference between actual and expected return. Resulting in the expected return is the pension expense. The difference between actual and estimated, it is loss or gain. So the loss or gains from investing plain asset is combined with losses and gains from revisions in pension liability. Okay? So how does it work? Or what is a plain asset? Resources which a company will provide a retirement benefit netted together with the PBO, with the pension benefit obligation, to report either a net pension asset when pension plan is greater than PBO, or a net pension liability when PBO is greater than plan assets. And how does it work? We have here we need a trustee. So this plain asset is not managed by our company. We hire a trustee, an individual, a bank, or a trust company, and they invest it in stock, bonds, and other income producing assets, accumulates the earnings, and pays benefits. So what do we do as a company? We recognize the earnings and recognize the pay benefits. However, we don't pay it. So we don't have a cash journal entry on plan assets. We debit PBO and credit plan assets when the trustee pays benefits to our employees. And when they accepted employer contributions, here we have cash. We are disbursing money to give them to the trustee. So the cash contributions is cash. We have a video about the journal entries where we work with this topic in a closer view. Okay, so let's go to our Excel file. Excel file here, we have the PBO here, we have the plan asset, pension expense, and you already had a new sheet here called journal entries that will be in the next video of our series about journal entries. So what do we have here on plain assets? Let's consider our beginning balance is $160,000. we have a 9% expected return, and the actual return is 10%. So the expected return, beginning balance times 9%. That is our expected return. Our actual return on plain asset less expected return. So beginning balance times 10% less expected return. Cash contribution, here debit plan asset credit cash, and less retiree benefits. So debit PBO credit plan asset. And the ending balance will be the sum of everything. So the sum, and here we sum it because the retired benefits, we are working with a negative number. So our ending balance will be 174. And here, the expected return is pension expense. Just like we worked here, expected return, uh, expected return being reflected in pension expense. And here, gain on pension asset. And this gain on pension asset is accumulated other comprehensive income. So it is not a gain in our income statement. It is other comprehensive income. It is uh, shareholders' equity or stockholders' equity. So instead of income statement, and here doesn't matter if we are talking about US GAAP or IFRS. Okay, guys, that's it. Thank you so much. If you have questions or comments, leave it here or email me at jscarping@gmail.com. Have a nice day and God bless you.